Hi, Jill. Can you hear me? This is Cassandra.
Hello.
Good morning. This is Cassandra.
This is Dwayne.
Hi, Dwayne.
Where is everybody?
It's a good question.
Hope we logged into the right link.
It looks like it. I mean, she has all the information pulled up. It's on the calendar. Let's look it up.
Send her an email.
I'll just give her a call. Maybe if she's at her desk. Well, she might be at her desk.
For your party's extension, you may dial. 1 moment, please.
It says somebody's on, host and co-host.
They might be muted.
Oh, maybe.
Jill Kaiser.
All right, she didn't answer, so let's send her an email.
There's somebody.
Oh, so we got somebody else? No.
I see a video. I see 3 people on a
Oh, okay.
meeting room.
I don't see anybody. I see you.
You
I
have
don't
to
see.
enable. Well, you see me, but
I do.
you don't see the 3 gentlemen.
No.
Oh,
I
wow.
wonder if there's like another view, like a gallery view, maybe. I don't know.
I'm on the fit to window.
Look at that. That's crazy.
Up
Okay,
top it says view options. I have fit to window.
Fit to window. Okay. Fit. Oh, let me email Jill. Oh, you said you saw people come in, so we're fine. Okay.
Yep.
Share screen now. Fit.
And I can see your name. I don't think your video is enabled.
How about now?
Yeah, now I can see you.
Can you see?
Yep.
I don't see myself. Why not? Let's see.
I see 4 windows.
That's.
I wonder where Virgil is.
I'd like to see those windows. Let's see. Calendar, City Palatka screen. I opened it up. Okay. All right. I see it now. Good. Thank you. Okay. So it looks like we're in the right place. We'll just give them a few minutes. Do you think they started the meeting and are on mute?
This is Dwayne. I'm here.
I wonder if they started the meeting and are on mute. Let me write to them. Let me try calling in.
Welcome to Zoom. Enter your meeting ID followed by pound. Enter your participant ID followed by pound. Otherwise, please enter the meeting time.
Good morning, everybody. This is Cassandra. Can you hear me?
Hello?
Hello?
This is,
afternoon. Can you hear us?
I can hear you.
Yes.
Can you see as well?
Yes.
Okay.
Let's see. Switch to gallery view. I can see everybody. I just not the meeting yet. Not like the material.
Okay. There you go. So they can't see the material.
I was able to see the material just a few minutes ago, but I don't see it now.
The only solution we have here is either you can see what's going on or you can see the material.
Okay, well, I
Because-
have the material here. I can pull it up myself. That's not a problem.
All right. Is that all right with you too, Dwayne?
I'm here.
Yeah, the solution to this issue is either you can see everyone or you can see the material. I can't show you both, given our new situation here.
Okay.
So you have a copy of the agenda, you have the information, but you'll be able to participate via Zoom and see the reaction. Is that all right?
Yeah, as long as I can see the presentation that you're going to put up, I'm fine.
That's the thing. I can't do both. I can't have you see the board and everyone else involved in Zoom, or you can see the material put up. It's the same material that I've sent you.
You can share screens.
We are.
If you want to put the material back up, that's fine with me too. Either way works.
Yep, that's fine. I don't need to see anybody.
They just need to hear. All right.
Reports. They just need to hear.
Okay. So put the materials back up.
No, they just need to hear.
They'll be able to hear, but they won't be able to see you people.
They don't need to see it.
I can see you guys just fine. And I see the material now.
Yep. Me
Okay,
too.
then we'll leave it as is.
Yeah, me too.
Perfect. Much.
What I was presenting to the board here was the CIT to replace the separate account management that we manage, and our group has been in contact with your team about holding a CIT instead of 60 different securities.
Sonny,
Can you hear me, Dwayne?
they don't appear to be hearing again.
I can hear you.
Oh, okay. Cassandra says she can hear. So Dwayne must be able to hear.
I can hear. I can hear.
Okay. All right.
Can he hear me?
He says yes.
Dwayne, can you hear Chris Greco here?
Barely.
It's probably using, this is not connected to the internet. No?
He's going through a speaker on
He's
your
going through a
laptop.
So
That's
I just-
going through that camera.
I know, but the internet is, the board feed is only through that.
Sonny?
This microphone only goes to the speaker.
And then that microphone picks it up.
From that microphone.
Oh, all right. Should I just talk to the camera? Because he can't hear me from 20 feet away. It might be-
Aim the speaker at the laptop.
How about
It's the camera that has the microphone in it.
why don't we try this? What if I talk next to this? I want to talk to the
Sure.
board.
How about if you light up your telephone?
Dwayne, it's Chris. Can you hear me? Hello?
I can hear. Yes.
Well, Dwayne, can you hear me now?
Yes, I can.
Okay. The laptop is what's live. Yes. All right. So the board's already heard. Dwayne, this is Chris Greco from Sawgrass. What we're proposing to the board is switching from our separate account, which has about 60 bonds in it, to a daily valued CIT through Alta Trust. It's the Sawgrass CIT offered at 29 basis points. And our team has been in conversations with your team as well as far as being able to hold the daily valued CIT. Is that correct?
I'll have to confirm that, but I've not talked to anybody. You may have talked to Anesta Boyce,
Okay.
but I'll have to confirm that with her.
I guess the key thing, Dwayne, would be, can you confirm, you guys can hold the daily valued CIT in the account for Palatka, correct?
Yes,
Okay. And that's really the key for you to know that your custodian can hold the vehicle that I'm talking about.
yeah.
And then Dwayne,
Yes,
beauty is they go from holding 60 bonds in the Sawgrass account to 1 daily valued CIT instead.
okay,
So that was the part we needed him to just be comfortable with that. So overall, this would be, I think, an improvement for your plan. And Burgess mentioned that he's reviewed the idea and endorsed it as well. So overall, we would just need the board to instruct us to move forward, and we would switch it over from the 60 bonds into the single CIT, and then you'd be saving money and gaining your liquidity.
So right now, let's say we want to raise $125,000. It's a relatively small amount considering the size. To be able to raise $125,000 out of the bond portfolio right now is somewhat cumbersome. Want to explain why?
Yeah, because when you hold 60 line items, then you would have to do a somewhat pro rata approach to make sure that the remaining portfolio still is similar to what you had prior to that cash call. Versus when you have a CIT, it's still the same 60 securities, but it's routed to this vehicle that you have different members that are part of this instrument. And when you have that same $150,000 cash raise, it becomes a lot easier, operationally, because it's a much smaller percent.
In fact,
of the
there may be
total portfolio.
cash, there may be $1 million in cash in the CIT and they just dip right out of the cash. They'll have to do all these little sales.
So it becomes a lot more user-friendly, operationally efficient, and you benefit by not incurring as much as you would if you had a separately managed account in terms of the transaction costs.
Now, as a trustee, I'm going to ask this question if I were a trustee. Why didn't you do this before? Why you waited until now to do it?
It's taken time for these fees to come down. The funds used to be in the 40 plus basis point, most on average in the mid 40s for a lot of mutual funds. And then once we were able to pursue getting the technology down to the 29 basis points, that's when it makes sense. If I came in here to say, you pay 40 now and the new CIT is 45, that financially it doesn't make sense and it wasn't right. But the math and the marketplace has come down tremendously to now where we can bundle this all up for a much lower fee, and partnering with a firm who only does CITs, which is Alta Trust as well. Technology's helped a lot, save costs.
It's still going to be the same security that you own, but it will be wrapped into this new vehicle that is a lot, that provides that efficiency for you and gives you a lower fee.
Discussion?
I think it's actually better. Because Cap Cities charges a handling fee for every security that's sold. Instead of, let's say, 20 pieces being used to raise a, from an example, just one. That's a fee savings as well. It's more efficient and easier to track performance. It's better for everybody. You get the same bang for less.
That's why there's a
Less
savings
money.
on the basis points.
Yeah,
It's an easier procedure.
lower cost, easier to, administratively easier to move the money around. It's a win all around. And the bank still holds, physically holds the collective investment trust is really what, that's what it stands for. Bank holds it for you. So it's secure on that level. Due to the performance that it's the same, it should be, in fact, if you net out the fee, it'll be better. So the performance drops, it was very poor, the fee would go back.
No. If performance were to go lower, So what we've got is you've got the normal performance, like the rest of this presentation will go with when Leardon talks about the bonds, the corporate bonds and all that. And it's just how it's held. Right now it's held individually, 60 bonds are at your custodian. Now it'll just be wrapped up all under one collective investment trust for much lower fee at 29 basis points. And that's the savings is because of the collective investment trust is a vehicle that we're pricing a lot lower than separate
You
accounts.
only have one little in your tax box instead of 60.
Yes, instead of looking at individual bonds, you will look at just only one security.
Yes. But you had 60 tackle boxes.
We've done this with, we have other clients that have gone in the CIT direction with other products. But this is not new. Any way we can defer or lessen costs is something we try to pursue. If you're getting the same service, same quality, same performance at a lower fee, then the net performance, when you take the fee into account, improves by the reduction in the fee.
Motion was made by Lenity to make the change. Adjustment.
So basically, what we're saying is the process of managing the bond issues. Like in your example, where if we had to raise money quickly, it's just going to save them time and money if we move to this, but it's one transaction instead of a number of things.
It also saves you though the money as well because your overall fee is reduced from 40 basis points
They have
down to
a
29.
model portfolio, and they touch it one time, and the whole model is impacted by those trades. Where when they have, 300 clients, it's a lot more work. You got to push 300 buttons, so it does save them money.
But it's also to your benefit because you also save on the transaction costs. You don't have to sell as many securities as you would under a CIT umbrella.
Second by Mr. Leary. All in favor? Aye. Motion passed.
So Cassandra will have to develop another agreement with them.
Well, there's a standard agreement that we've already sent over to them.
Okay, well, she'll comment on that later.
Yeah.
Okay.
All right. Well, great. Thank you. And we'll be able to make that happen as quickly as the paperwork can go through. So everything else.
Cassandra, did you say you sent me something already? The agreement?
I sent it to Bonnie Jensen about.
Okay, I'll follow up with Bonnie because I haven't seen it.
All right, great.
Let me see if I can follow up.
And then I'll be your contact for that, Cassandra. I'm Chris Greco with Sawgrass.
Okay, great. Nice to meet you. Thank you.
All right. Well, we'll follow up with the nitty gritty later, but let's get into the good stuff. The money that we managed for you today in the book on page 10. And by the way, everything will continue in this format going forward. Even if you're in the CIT, it's just the rest of the book will be the same kind of format that we've always provided to you. So I'll let Leardon Gila talk with you starting on page 10 about the assets we manage for you and overall how he's been navigating the bond world. Leardon.
Thank you, Chris. Good morning, everyone. Good morning, everyone. My name is Leardon Gila. I'm a fixed income portfolio manager at Sawgrass. First, I wanted to thank you for the opportunity to manage your fixed income portfolio. We appreciate your business. So today I'm here to talk about the portfolio review for the quarter and the last fiscal year that we just ended. So if you turn with me on page 10, if we just start with the market value, we finished the fiscal year with a market value of $2.44 million. And if you look at the beginning of the fiscal year, we started with the amount of $1.835 million. And if you look at the cash flow calendar there, we had a net cash inflow of $449,000. And then the investment gain of $155,000. So that adds up to that 2.44 total million. So if you look at the performance on the next page, on page 11, we finished the fiscal year with a performance of an 8% total return for the fiscal year, handily outperforming the benchmark by about over 100 basis points, 115 basis points for the year. And that brings the 3-year annualized return to 5.8% and the 5-year annualized return to 4.7%, handily outperforming the benchmarks in both those 2 time periods. These are some really, really strong absolute and also relative return numbers, especially given where we started, where everybody was expecting a much lower total return for bonds going forward, given how low the yields were at the time. These types of returns have truly been a huge surprise for the financial markets. And to say the least, I mean, this year has been, as you all know, has been truly extraordinary, not only for the financial markets, but for everybody. So to have this kind of number, this kind of performance in this very, very volatile number, we're very proud of these numbers, and your portfolio has done very, very well. In terms of looking at the performance drivers, if you turn with me on page 20. This chart illustrates what essentially has been the biggest driver of the return, which is essentially sector allocation. So this is the credit, what we call the credit risk ratio, which essentially looks at the corporate bonds allocated for the dollars and adjusted for the sensitivity and quality, and measures that same ratio, same variable to the index. So what this means is that if you're below 100%, you're technically underweight risk. If you're over 100%, you're overweight risk. So if you look at this chart at the end of 2019, you can see that we went very underweight. We turned very cautious on corporate bonds because at the time, corporate bonds were trading very, very rich relative to historical levels. And especially when you adjust it for the historical trends that we've seen, meaning a lot of these companies, a lot of corporate America have been more comfortable with downgrading their balance sheets, raising the debt levels, raising the leverage levels. And a lot of those proceeds have gone to the share buyback. So it was a cheap way for them to enhance the earnings per share without having any earnings growth. And they would fund the proceeds by raising debt. So a lot of the companies have done that transaction over the last decade. And the net result has been a huge increase, a huge systemic increase in leverage for corporate America. So one, we have a much higher leverage in the system. 2, the CFOs, a lot of these companies have termed out the liabilities, maturities. So if you look at the composition of the corporate market, the average maturity now is much, much longer than what it used to be. So when we adjust historical rich levels in bonds, and we adjusted for lower quality and longer maturities, at the time we made the decision that corporate bonds were trading at essentially record levels. So we turned very, very cautious. We went as low as 50% underweight. And that really benefited your portfolio at the beginning of Q1. Now, we didn't forecast the pandemic risk, but because of our underweight, we benefited on the way down on this huge sell-off that we saw during the first quarter. We saw the fastest sell-off in the equity markets in history. The S&P crashed 36% in just 23 business days, and same kind of flavor applied to the risk layers of the fixed income. So we saw high grade markets, high yield markets. They essentially all froze during March, and then we got the Federal Reserve intervention when they came. One of the weekends they had that emergency rate cut to 0. They initiated the bond purchase program, and when they included the corporate bonds into their asset purchase program, which was a record, a completely new thing in the history of the Fed. That's when we really pivoted your portfolio and we started adding a lot of risk towards the end of the first quarter and the second quarter. So if you look at the second quarter, it was the opposite of first quarter. Second quarter was a risk on, pure risk on because of the Fed-driven rally. So we benefited on the second quarter by being overweight credit risk. You can see this line here. We went from 50% to 120%. So we benefited in the second quarter by being overweight corporate bonds. And we also benefited in the first quarter by being underweight corporate bonds because of the sell-off.
A question for you.
Yes.
I'm still looking at 20. Is that green line still below 50%, 100%?
So and recently we've dialed it back to neutral because we've had such a spectacular rally in investment grade bonds that in many cases we're essentially trading back to the pre-pandemic levels.
Well, with the introduction of these vaccines, Pfizer, and looks like Moderna probably this week, wouldn't you be more optimistic?
We would be on a more selective basis. So we believe that going forward, it's going to be more of a bond pickers market as opposed to I just want exposure to a sector. It's going to be a much more differentiated market. So being a little bit more selective with regards to where we get the exposure.
Right.
But to your point, yes, it's going to be definitely the tone is more optimistic. But in certain cases, you've got sectors, you've got issuers that are trading at incredibly rich levels because the Fed is supporting the market. And everybody believes that you got the Fed put, and they're buying at these really, really credible, very rich levels. So with that type of environment, there are certain pockets where we feel that the risk reward is to the downside. So that's when we've dialed back the risk a little bit. Yeah. So the third quarter was similar to the second quarter in terms of the theme, just a continuation of the risk on, the Fed supporting the markets, stock markets making essentially all-time highs, spreads outperforming. But the magnitude was much less than the second quarter. So in the third quarter, we had a positive security selection, picking the right securities. That was another driver of the return. So essentially, just to kind of put it into perspective, sector allocation was the biggest driver of your returns. The duration, meaning the interest rate risk, was a neutral effect. We didn't make any big allocations there. So it was all about having the right positions at the right time in the corporate risk space. So looking forward, the way we position your portfolio currently, if you look on page 26, these are some of the recent changes that we made. These are the quarterly changes from second quarter to third quarter. You can see, if you look at that top half, the duration ratio, so that is your interest rate risk. We haven't done any changes there. So we still have maintained a neutral approach there. And to George's question on that credit risk line, you can see that we've pared that back to essentially neutral from 120%. And the reason behind that, as I mentioned, is because we're now, after this major rally, we're being a little bit more careful, more cautious, given how much we've run recently. So we have pared back the corporate bonds a little bit. If you look at the bottom half of the charts, you can see that that reduction in corporate bonds has essentially gone into the mortgage space. So we have swapped some of the credit risk for more mortgage risk. Now with mortgages, you don't have credit risk because it's guaranteed by Fannie, guaranteed by the government. There you've got prepayment risk. So there we're actually we're willing to take the carry, we're willing to take that extra income by being very nimble, by being focused on managing that prepayment risk. So at the end of the day, you still benefit from that higher income, higher carry strategy. And then finally, going into the next page on page 27, if we look at the current portfolio characteristics, you're still looking at a fairly low yielding portfolio. That's because all the rates are very low. The Fed is keeping rates anchored at zero in the front, in the short-term rates, and pretty much all the action is toward that longer part of the curve. But the overall yields are fairly low. We're looking at low single digits. The duration, as I mentioned, the interest rate risk is recently we have pared it back a little bit. So we're being a little bit cautious there. And if you look at the sector allocations, we're still are heavy underweight treasuries, slightly overweight in dollars for corporates, but overall we're neutral, and a slight overweight in mortgages. So that's our current strategy right now. In terms of what we expect from a macro standpoint, we're still in this kind of a macro hole. We've got this huge hit to the aggregate demand, to the overall aggregate output. And all these packages that we've heard, the CARES Act, the stimulus from the fiscal policy, and this continuous buying from the monetary policy is basically going towards patching that major hole that we caused during these lockdowns of this year. The big theme is what's going to happen in the medium term. And our view is that, at least in the near term, we're not going to see a huge run up in rates. And that's because the Fed has communicated, at least over the next few years, they're going to keep the rates at essentially zero, just to continue to support the economy. But as we normalize, and as you see this huge money supply that has been infused into the system, and couple that with a merging of fiscal policy with monetary policy, which is essentially a new phenomenon, basically these two policies cooperating together, studies have shown that tends to be highly inflationary down the road. So we have turned a little bit cautious with regards to longer term rates. We might see more pressure on those longer term rates. In the short term rates, they're basically anchored by the Fed. So we might see what we call a steeper curve, meaning longer term rates being much higher than the short term rates. So with that kind of view, we have positioned your portfolio to benefit from that type of pattern. And we're being a little bit more careful and more conservative with regards to the exposure towards the longer term part of the curve. So that is kind of our general thesis. We are in that path of recovery. In the near term, we don't see big inflationary pressures, but in the longer term, when we look at what's going on from a fiscal standpoint and monetary standpoint, we see much higher than expected inflationary pressures down the road. So with that, I'll conclude my brief presentation and I'll take any questions if you have.
You mentioned the mortgage rate. Is that risk very low, or you don't measure that?
And so it all depends on where are you in that universe. We have made the decision to focus on the recent production, and we're talking 30 or 1.5 coupon that has a weighted average coupon of at the retail level of 2.5%. So if you look at the current 30 years, if you look at the quotes from Bank of America, Wells Fargo, everywhere, nobody's quoting you less than 2.5% 30-year mortgage. I mean, it's hard to find anything like that. So the recent purchases that we've made have very, very limited prepayment risk. The ability to refinance, given such low rates, have been diminished significantly. So there we're taking that carry strategy, but we have eliminated, I wouldn't say eliminated, but we have significantly reduced the prepayment risk.
Any other question?
Motion approved.
Motion made by Linda to approve the Sawgrass report, second by Leary. All in favor?
Aye.
Aye. Motion passed.
So going forward, this strategy will be the exact same for the CIT because it's the same strategy. So it's just a different vehicle. It will be the same exact presentation.
Thank you. Next up, we will have Capital City, Mr. Madden.
Okay, good morning. Can everybody hear me?
Yes, sir.
Okay, there's the report up on the screen. And if Jill, you could please scroll down. This is the third quarter, right there, the policy review. So this is the third quarter report, and this is the policy allocation view of the plan. And so I want everybody to know that we currently are still, as we were last time, overweight large cap US equities by a good amount, 15%. And this is causing some underweights in other parts of the equity asset class. Underweight to international, underweight to mid cap, underweight to REITs, which we count as equities, or the plan counts as equities, underweight to infrastructure, and even underweight to convertible bonds, which have an equity-like component. So we still have a bias towards large US companies in the S&P 500 index, which are now 30% in technology, if you count communication services. This is where we believe the growth, the best sustainable growth lies. Companies like Apple, Amazon, Microsoft, Target, and Walmart, just to name a few. Cash is a little underweight because we aren't earning much at all on cash. And so I'm trying to keep money in the market, but we are at the point where we're close to our policy cap on equities, and it may be in the near future I will be moving some cash over to Sawgrass to keep the equity amount under the policy cap. Any questions on the asset allocation? If not, we can scroll down. Jill? There we go. Count performance, right there. There we go. That's as of September 30th. And the latest 1 year as of September 30th for the part that we manage is 10.91. A good number, especially because it exceeds the actuarial rate. Equities returned 10.4 over the last 12 months, ahead of or right with a global equity benchmark. Because you have international equities that lag the S&P 500, bonds were up 22%. That's a result of a good policy decision. Because you hold convertible bonds and high yield bonds, they did quite well as interest rates came down, and they also have equity components built into them, so they reacted with the upside in equities. Real estate, latest 1 year is down 12%. As we know, the economy has made it tough for businesses to expand or sometimes even pay their rents. So real estate took it on the chin. Although we have a small amount in real estate, it did not hurt all that much. So the latest quarter, which is what we're talking about this morning, the fund returned 8%, 8.1%. Equities were 8.23, which beat a global equity benchmark. Bonds were 10.58, again, benefiting from lower rates and a better equity market. Real estate starting to recover, 1.28. And cash again is in treasuries, which is paying almost zero. So, in lieu of COVID and a recession, the latest 1 year number is not bad at all. Fortunately, the Fed stepped in and backstopped the economy. And had they not done that, things would be a lot worse than they are today. So any questions on the performance for the third quarter? If not, Jill, we can scroll down to the next. That's as of October. September and October were down months in the equity market because equities started to get expensive, and there were some concerns about the vaccine and the election making the market nervous, and so. These numbers are as of October, where you can see the latest 1 year came down a little bit. But still, the 1 year number is decent. Equities still are positive for that quarter, even with October thrown in there. So Jill, if you could scroll down a little bit more. Here we have the asset allocation. This is as of, I believe it's the date is at the top. There we go, December 1st. There we go. 59.8% equity, and that's counting equities only, not bonds. And so you're in a moderate growth portfolio. It's not aggressive, but it's not balanced either. It is definitely a growth portfolio that will do well in up markets, and it has. And we currently hold about 3% in cash, which is about where I want to be, because there may be a pullback in the next 2 weeks as some portfolio managers square up their positions. Currently, the market value is $8,660,594. And so, any questions on that? If not, we can scroll down to these are just the bonds that are in the portfolio and some of the mutual funds. I don't really need to go into that, but they're there for your inspection. And that concludes my comments. Any questions? No questions? Then that concludes my brief remarks.
Motion approved by Mr. Leary. Second by Lindsay. All in favor? Aye.
Yes.
Motion passed. Thank you, Mr. Goy.
Thank you.
Mr. Burgess?
All right. Sawgrass's report, go back to page 27. I want to make while they're here, an observation. It's very interesting. The yield to maturity is 1.18%, a little over, almost 1.2% rounded. And the coupon, average coupon is greater than that. And the reason why the coupon is greater is because
The premium bond.
yeah. So the bonds there in your portfolio, on average, were purchased at a price above where they will eventually mature. That's just the reality of buying bonds in the secondary market. The preponderance of equities that are in the other side of the program are yielding somewhere around 2%. So in the history of this plan, this year was probably the first year that the equities are actually generating more income than the bonds. The last time we really had an environment like this was in the 1950s. After World War II, bond yields were still very low, and equities in those days were purchased to a large extent, even in the 60s, not on the basis of their growth potential, but on the history of the dividend history. That income, the majority of the income was being collected off of the equities, not the bonds. In those days, the bonds were a very safe place to invest your reserve money with the hope of when you, like a CD, when it matures, you get your money back. So we're in very strange times right now, very asymmetrical times in capital markets. I just wanted to point that out. Okay. You like that?
Great intro.
Okay. Page 1 in our little brief summary. Maybe another report in there if you want to look at it. The takeaway on this piece is on the third paragraph, first line, all the way across. Growth stocks, technology stocks, versus value stocks, like utility. The value stocks have trailed the growth stocks by so much that in the first 9 months of this year, the growth outpaced value by 37 percentage points. Historically, when we've seen periods of the market being in such a divergent state, it doesn't last very long, and when it breaks, it snaps back the other way. The last time we saw something like this was in the night. We saw this divergence in the late 1990 period, 98, 99, 2000, and we saw this snap, 2001, 2002. So our view is that growth stocks are way overdone, and the value stocks will be coming back. Now, the reason I mention this is that Dwayne, on the large cap side, I'll show you in the book here. If you go to page 13, or let's see, page 11. Within the domestic equities, that's what we're talking about. He's not buying growth or value. He's not trying to figure out if it's time to move back to value or if growth is overdone. He's investing in the core, the middle, and that's what the S&P 500 is. Now, the S&P 500 this year, since January, is up about say 15%, but the growth stocks are up 30. And the value stocks are still kind of nursing their wounds at around 0 or -3 or whatever. So that's a risk reducer. The program is not taking any bets in terms of growth versus value. That was the point there. While we're on this page, I'll come back to the summary in a second, you can see that at the top of the page, the plan earned 9.8%. And the average or median performer for the year was about 7.4% on page 11, the top there. So both our universe that we subscribe to and the Wilshire universe, which compares all these defined benefit plans, have essentially the same distribution of rankings. You rank in the top 18th percentile for the year. And that's remarkable. And I would say, having talked to others around the state, I was talking to one of the actuaries yesterday, even in the state of Florida, 9.8% is well above average. You go across and look at your 10-year average of 8%, top 37th percentile. So the town of Palatka, under the steward's leadership of Dwayne Madden, really done an outstanding job there. Very good. The big story, really, though, for this year was the convertible bonds. They were up 36%. In fact, since January 1, they're up 45%. So where we have exposure with other accounts, clients, and convertibles, or we're trimming back now, you had an underweight throughout the year, but that's okay. You've had an overweight to equities, which made up the difference. Small cap, mid cap, did not have impressive returns for the 1 year period ending September 30, but the quarter we're in right now, which will end in a couple of weeks, you're already up about 9% in the last 2.5 months. In part because of mid and small cap, because they've really taken off. You should also note the international, the American Fund Zero Pacific Fund that you're in was up 15.5% for the year. It just blew away at the index. Let's go to the next page. This is interesting. On page 12, Dwight has an underweight to REITs, which has actually benefited you. The REITs were clobbered in the first quarter of this year. They were down about 33%. But year to date, they're now only down about 8%. So at the beginning of this COVID, we called it the COVID hurricane. At the beginning of this thing, everybody decided to get out of publicly traded real estate because they thought everything in the real estate world, especially retail and office, would deep dive and they'd lose a lot of money. So the market took a deep dive, but really there was a nice recovery in the second quarter, not that and a recovery to some extent, but not terribly impressive in the third quarter. But the quarter we're in right now, the REITs have made another 8 or 9% move back. So there's an example of the market overreacting. So let me go to the page 8. Look at the allocation, make a comment. At the end of September, you can see the domestic equity target of 32. It was an overweight. And this is Dwayne's call, 11.6 percentage points. That has helped you. The underweight to infrastructure has helped you. The underweight to convertibles has been somewhat of a distraction, as well as the underweight to international. The underweight to REITs has benefited you. And more recently, there shows an overweight here to fixed income, but throughout the year, fixed income has been a very good performer for you. On page 7, you can see how the numbers look historically, going back 10 years ago. You were just shy of $6 million in value. This report production, you're at 8.4 million. You're over 9 million now. And you can see that you earned $5.2 million in the last 10 years. Page 4 wraps it up with the investment summary. This is by no means an aggressive program, but with a 65% target to equities. There are other programs that we're privileged to work with that are 70%. We have a client that's even a little higher than that. So those are the returns historically. By the way, the Florida retirement system in October lowered their return assumption to 7%. And I believe you are above that right now. I think are you at 7.5? Can look it up. Do you know?
I don't know what,
I got it in here. I find
I
it.
know we were going down, but I don't know where we're at.
Were you going in baby steps?
Mhm.
Yeah. I think it's in there somewhere.
I don't think we're at 7.5 yet, I don't think.
Joe can find it. Oh, here we go. Seven and 3/4 was 2020. 7 3/4, and I think you're moving towards 7.5. but
7.5, I think was our bottom.
Yeah.
I believe.
So we don't recommend any changes to the strategy. I think next year is going to be a very interesting year in terms of as the economy opens up, there's going to be a big jump forward in spending and in economic activity. And I think that may be why you're a little bit concerned about inflation next year. But we're very confident that you will exceed your actuarially assumed rate of return for this coming fiscal year because you're already at 9%.
Question on that, because I've had new chiefs ask me. It's always been, we're waiting for these bad years to fall off, and they want to know about. I guess him looking at a budgetary point of the cities having to put in more and more money, that's going to happen when we lower the rate of return. The city has to pick up the extra on that. But where are we at? I mean, so this year, you said we're already at 9.
The new year.
The new year.
Go to page 18. You can see that historically this plan has performed quite well. We've only really had, in the last 11 years, only one significant negative fiscal year, and that was in 2008. The cost to the city of maintaining the plan's integrity is a complicated question because the actuary is the one that really develops that model based on the actual tables, turnover of the department, raises, all those things that or lack thereof, not just investment returns. But from an investment standpoint, as you saw in your 10-year average, you have achieved your assumed rate of return the last 10 years. Not every year, but on average. I think if the chief wants his plan to make more money, we would have to dial in more risk. And I'm afraid to get another 1.5% return out of this thing, the amount of risk that you'd have to take to get that would be, it's not a linear, it's not like every unit of risk you take, you get another unit of return. It's a non-linear relationship. So you have to take a lot more risk just to get a little bit more return.
I don't know if he was asking for that. He was just asking questions.
I'm happy to meet with the chief anytime you want me to. head over there with you and at the station and talk to them, I'm happy to do that.
Okay.
All right.
Like I said, he was just asking me some questions about it, and I was trying my best to answer them. So, any questions?
That's it. Thank you.
Motion by Lindsay. Second by Mr. Leary, all in favor? Aye. Motion passed. Next up will be Ms. Cassandra.
Good morning, everybody. Can you hear me? Hello?
Yes.
Yes.
Okay, I could hear you. Thank you. I don't have anything to report this at this meeting. But I did just want to let you know I did receive the agreement from Sawgrass. They just sent it over to me over around 10:30. So I will take a look at it. I will work on it, and we'll get it executed as soon as we can. So thank you, everybody. And sounds like the investments are doing well, and I hope everybody stays safe and has a happy holiday.
Cassandra, can you hear Burgess? Cassandra? Why don't you
Yes.
ask? I know that the governor has rescinded the law that allows these plans to meet remotely. As far as the having a quorum is concerned, doesn't your office have a view on this, that they could continue to meet remotely here, even if they didn't have a quorum at the pension office?
So it's my understanding that we, in our office, we are of the opinion that the hybrid meetings are what the board should or could be using during these times. Because yes, as you mentioned, the executive order suspending the physical presence requirement was not extended at the last time it could have been. So we are recommending that the boards, of course, the cities may have their own view on it, but our view is that we can have a physical presence in a location, in a public location, and then the remaining trustees can meet virtually. They can vote on issues as well, so long as there is a physical presence there.
It's really about the quorum. Do they have to have 3 members here for the quorum?
Yes, that is the opinion that we are going with. That's what the AG's opinions state. So although that is for the state law, not so much for our municipalities, but that is what we're going with.
Thank you.
You're welcome. Any other questions on that or anything else? If not, then thank you again.
Thank you.
Expenditures.
Expenditures were.
Those are for the year. The expenditures are based on the whole year. Fiscal year, the entire fiscal.
How do they do relative to the budget?
Well, unfortunately, Foster and Foster, some of their charges were from prior year because of the meetings that didn't happen. So some of the Foster and Foster charges went over, but
I don't know if this is now or other business, but it is kind of expenditures. Is we need to figure out how we're going to pay these employees that are leaving a little faster than what they're being paid.
contribution refunds,
Yes, ma'am.
they go through the HR department.
I understand that. I'm just saying that an employee that left the department almost 2 years ago that still hasn't been refunded his contributions is an issue that we need to figure out. I don't know the answer to it. We can sit down with HR, but
Is that a city thing or?
yeah, we had a firefighter quit in June of, I'm gonna say it had to be 19. I don't want to say 18. And I just found out 2 weeks ago that he still has not received his.
There
Yes.
are reasons too. There is a bunch of paperwork they have to fill out to get their contribution back, I know, from HR. And generally when they leave, they get that paperwork. But if they choose to leave their money at the pension with the idea that they might be returning at some point, I believe that's why HR hasn't pursued them aggressively to get their paperwork back, because it's their choice to return that paperwork. However,
From what I've been told, they were never given the paperwork.
well, and that's
They just thought
that
that it was, so I don't know. If that's
automatic or something.
that,
Yeah, I think there needs to be some education during that.
Did they just contact you and get the paperwork?
No, they can't contact
contacted me.
HR. There's supposed to be there's supposed to be a termination procedure such that they terminate with their superior, they come to City Hall and they fill out paperwork and do a termination process with HR. Whether that process works or whether it's
So
not
I guess
working,
Chad and I need to be just making sure that anybody that leaves.
goes to HR. Yeah, because there is definitely work that, just like right now, if somebody left right now, our HR would need to know, what their current address and what their future address is, because for, to send out a W-2 for this year, we need to know where they're moving to. So even if they terminate at a department level, that's not adequate. It really needs to come to HR. But that's really HR's department and not pension at this point.
Was this person non-vested?
No, they were not vested. They were only
4 years, 5 years?
3 or 4 years, maybe.
So, let me ask another, I'm just curious, if someone is decides to, you have a drop here, right?
They can't go and drop until they're vested.
Yeah. So how long when someone leaves the department, leaves employment, can they leave money in the drop for a period of time?
The drop, there's different rules for each of the pensions, but I believe for the fire pension, they can leave their money there for a period of time, but they have to take it out in thirds. There's different regulations.
We did have one employee that took his every year for 3 years.
Yes.
So by the third year, you have to have it all.
Yeah. But that, like I say, varies per pension. And I know for a fact, there's some people with money in for the last 10 years.
So the other question is, if someone leaves, and they're not vested, in this example, let's say hypothetically it's 24 months ago, if they have not filled out the paperwork and done what was required, they would not get any interest on that money for the last 2 years, would they?
No.
However, if they had done everything as required and the city just didn't get around to paying them, is there a policy where they would get the interest?
If they had filled out the proper paperwork, I'm sure there would be
Okay.
a requested.
There'd be at least they'd have
Yeah, they,
actionable with the
Sure.
board.
I'm not sure. Like I questioned him when he messaged me. I was like, why have you been gone this long? And we're just now questioning that. I mean,
wouldn't have let it go on that.
I wouldn't let it go on that long either personally. I mean, I'd have known that money was there and coming back to me. I'm vested, so I'm not pulling mine, but a lot of fire departments are hiring right now and a lot of people are leaving. So
And I believe in the ordinance for the fire department, after 5 years, then the board is supposed to contact them. But until it's gone to 5 years, it's not, it's up to the individual.
and you said you had some that's been there for over 10 years?
That's in the general, and they don't have that
Oh,
in their ordinances. So it's,
okay. I
yeah,
was make sure it wasn't us. Like I know we have some people that left their money, but they were they had vested, so you
Right.
know, they can draw on it when they become eligible. But okay, that's fine. I was just wondering because, like I said, I saw one.
There has been significant delays in the last several years.
Okay, well then I'll just, when I know somebody's retiring, I will tell them to.
Yeah, make
All I
sure
have to do is tell
they
them
go to
to go
HR, make sure they document their process.
Okay. Any questions on expenditures? Shouldn't have been too bad because none of us went to conference this year.
Right,
So
yeah, we didn't.
no questions heard. I'll make a motion to approve expenditures. Second by Mr. Leary. All in favor? Expenditures passed. Board meeting for
There's a schedule for dates. So it looks like this, follows the same pattern that we have.
March 16th, June 15th, September 21st, and December 14th of 21.
On that.
And public comments?
Let me call over to see if they're monitoring it next door to see if there's any comments. She's not available.
See him.
Hi, Sunny, this is Jill. Is there any public comment? None, okay. All right, thank you. No public comment.
No public comments. Our last item is board members' terms expiring.
Yeah.
So Chad. Let's be posted and voted on. Mr. Leary and Mr. Lenedy.
Right now, it's just Lenedy, Chad, and Leary all expire on January 2021. It says in the ordinance that if you want to continue, you just vote to continue. You don't have to repost.
Chad has to be voted on by the fire station.
Okay.
I do know that. I have to post it and everybody will vote that. I've never had a vote for
Other members?
the other members.
Okay,
It's just been the two that's active members of the station.
okay.
But I can post that and get the results to you
All right.
on that. As far as the other two, it's
As long as they
their
agree,
decision, I guess.
yeah, to continue, it just continues. Okay, all right.
All right. We'll make a motion to end the meeting at 11:19. Second. All in favor? Aye. Have a great day. Thank you, Mr. Leary and Mr. Lenedy, for your presence. All for coming in.
Thank you. Thank you. Thank you.
I'm turning it off.
And this is
Thanks again, everybody. Stay safe.
Thank you. Happy New Year.
You too.